Hello and welcome to another episode of the Paperstac Podcast. I am Brett Burky. This is Rick Allen, and we are here.
It's Rick
Allen.
Rick Allen.
And so we're here for some other knowledge drops, fun stuff that we come across, that we learn, or questions that people ask us, and I go, that's a good question. And then, anything new? I mean, I'm not going to call out the elephant in the room unless you want to address it.
Yes, I have a black eye. No, I wasn't back talking my wife. It was actually, I got 3 kids and we were playing basketball. We go to the basketball courts a lot. And my oldest is now 15 and just, he's a beast. Like squats 325 and just plays real aggressive. And so he was going up and just threw an elbow and it caught me in the eye. And I was just like, I didn't even think anything of it because you're playing ball, think about it. And then Sunday night, my wife's like, what happened to your eye? And I was like, what are you talking about? And I went and looked in the mirror. I'm like, And then we were going to shoot this podcast. I went to the bathroom, was washing my hands. And I go, no!
I saw it yesterday. I didn't say anything.
I actually was wondering yesterday. I was driving home, like, they must... I know that the attention to detail is more than that. They just must not wanted to say something.
It's one of those things where it's like if
which is better because for me, I would have been like, Brett, what the hell happened to your eyeball?
I know.
Did you just back talk Natasha or what?
No. I was like, well, if he wants to talk about it, we'll talk about it. But everyone's working and we're doing stuff, so I was like, yeah.
I just forget it's there. It's like it doesn't hurt or anything.
No.
So.
Okay, well, we figured out what's going on there. So today we're gonna start a new series. So we're gonna do mortgage notes versus whatever. And so
this is the versus series?
Yeah, it's gonna be a small little series of the verses. And so
are we gonna do like a bracket?
What do you mean a bracket?
Like bracketology, like it's going to be like, okay, which one wins? And it was like, today it's notes versus single family rentals, and then notes takes a victory, moves on to the next round. Probably not. I mean, we could, but there's a lot you'd have to look into. Let's just do the verses, and maybe we can follow it up with a bracket.
Okay.
Because I don't think there's always a clear-cut winner.
There's not. I mean, that's the thing. So I had this conversation with somebody yesterday, and so he's a person who sold his companies, had a really interesting story. I mean, I love, talking to customers sometime and hearing how he got into his first rental, which he won at an auction. It sounds very familiar. Won at an auction on the courthouse steps, paid $30,000, didn't tell his wife, but he did it years ago and he kept that for decades and exited just recently with that one for like a couple $100,000. So but it was one of his longest rentals, but that got him into the space of rentals. And he was like, I'm tired of doing rentals, that's why I sold them. But he's like, I like what you're doing with notes. I love this idea of Paperstac. I'm just trying to determine, what's the benefit of doing notes over rentals? Which one's better? And my answer to him was basically, I don't think you have to look at it like which one's better. They all have their different distinctions. Like there's things about mortgage notes that are great, and there's things about rentals that are great, and there's things that, I was like, that's a good segue into actually being able to compare apples to oranges, or apples to apples. And so basically saying, all right, there's mortgage notes, and then we're starting with single family rentals. What are the benefits of each in, kind of a versus series? And so Rick's had a bunch of rentals and he's had a bunch of mortgage notes. So that's where we're starting. So Rick,
yes, there was a lot here, so I had to make some notes for myself. I think the first, you talked about how that guy got into the rental space is he bought that first one.
He bought the first one, yeah.
So I think the biggest thing you kind of look at, or the first thing we'll look at, is market penetration through your initial capital investment, right? Right?
That
Typically, rentals are going to require much larger investment up front.
Than a mortgage note?
Well, let's...
Okay, keep going. Right.
If you're going to buy the entire property to turn around and rent it out, now, and I'm taking off the table, you're renting out, you lease a property and then you turn it into an Airbnb and you're trying to make the delta there, right? I'm not talking about that. I'm talking about just buying the investment.
Okay.
If I'm going to buy an investment and we'll just say, look, hey, have you bought any mortgage notes right now off of Paperstac? Or have you bought any mortgage notes through your snowball stuff?
You talking about me?
Yeah.
Yeah.
Yeah. Right? They varied from X amount of dollars up to, whatever. Imagine trying to buy a whole house, which takes less capital.
I mean, that's where I'm kind of confused, because the mortgage, I have to buy it all, and with a house, a lot of times you're at least getting a mortgage and you're getting a renter.
You could get a mortgage and get a renter, but say you're going to buy a mortgage for, say, $20,000, or you're going to buy a house that's going to cost $200,000. You're probably going to have to put down 10, 20%.
Yeah.
Right? You can go buy a mortgage note for $6,000.
Right.
You could buy a mortgage note for $10,000.
Right.
So, and this is generally speaking, it'll take less capital to get involved if you're buying a performing mortgage note than if you were to buy a rental property and go through.
That makes more sense. Yeah, because a lot of the mortgage notes that I've bought have been around $15,000.
15 grand,
yeah, 15
right?
grand. Mm-hmm.
If you buy a rental property and you have a mortgage on it, you've got closing costs plus down payment. If the renter stops paying, what happens?
Yeah,
you got to pay that mortgage still. So it's just less capital intensive. Buy a performing mortgage note, if they stop paying, you're going to have your servicing fees to cover. Yeah. So it's less upfront capital.
I could see that. Yeah, that makes more sense, because now if you're doing the idea of you're putting 20%, but also too, finding a house that's $60,000 and wanting to put renters in there, it sounds like a terrible idea. You want a house that's at least $100,000, right? I mean,
and maybe it just depends. Like, it's and this is one of the things that we'll talk about in a little bit, but it's really predicated on market conditions.
Right.
If you go look at 2009 and 10, there were houses that I was selling in 2006 and 7 when I was wholesaling for $180,000 as a wholesale deal, that I could go back in 2010 and I could buy those same houses for 15 grand.
That's crazy.
Right? So if you could buy 10 of those for 15 grand, you put in your money to rehab them, you got whatever, say you've got 3 to 4, 500,000 wrapped up into it, but you got 10 houses that you're renting out for $1,000 each.
Yeah.
Right? So, I mean, at that point, you're like, I'd much rather have, it's all market. It's all predicated on market.
That makes sense.
Right?
Okay.
So, and now those same houses, guess what?
They're worth $500,000.
No, they're not. Those houses that you were buying at 15 are not worth 500, but they're back right up to where they were past it even.
Right.
Right? So now those same houses are 225, 240, maybe 250,000 and this is, we're talking our local market here.
Yeah.
Local market here.
Yeah.
Now, there's other strategies to buy houses, whether you're buying tax liens and turn them into tax deeds or stuff like that. Sure, there's always the creative way, but we're talking just generally speaking, less capital to get involved with mortgage notes. So that's one thing.
So 1 point for mortgage notes, 0 points for real estate rentals. Okay.
So the next thing is you're going to look at is cash flow. Rentals can generate a ton of cash flow. And the nice thing about the rental market is what we've seen is the rental market has gone up. There's usually rent increases built into
annual.
There's annual rent increases. It bumps up until you find a market, and you maybe hover there for a little bit and it goes up a little bit. But your cash flow can vary on vacancy.
Right.
Or renters not paying. The thought process is a renter is less financially stable maybe than somebody who owns a home. Okay,
I could see that too.
Right? Conversely, with mortgage notes, it's more predictable cash flow. It's like, look, this is what it is, but there's no mortgage. You're not increasing you're not saying, okay, well, we're going to pay more on the mortgage. No. If you ended up buying a mortgage note, say 3 years ago, and it had a 6% interest rate, you were like pretty happy. You're like, that's good, better than I'm getting in the market. Now, if you were looking at a 6% mortgage rate today, you're like,
better have a hefty discount.
Better have a big discount because you're looking for a higher return. So that's one of the things with mortgage notes is it's more consistent cash flow, but when you lock it in, you're kind of locked in.
Yeah, which is good for someone who owns a mortgage.
Which is good for somebody because if you own a mortgage, it guards against, you're not renting, so it guards against the rental inflation. Right.
Only thing you have to worry about is the homeowner's insurance changing.
Right. So now the next thing after cash flow is we're going to look at the management side or the maintenance side.
Oh, I mean, you can already throw the point up. I already know where this is going.
Right. If you're on the rental side of things, you're going to pay a property manager to manage it unless you're going to manage it yourself. But you're also going to start incurring cost on the repairs and maintenance on the home. Septic system. You could have great payment history, and you got to put in a septic system. The septic goes bad. Maybe it's got to be a new septic system, like Florida's got these new requirements.
ATUs?
Yeah, something like that. And so those are
aerated.
a lot more expensive. You got to fix a drain field. You got to put on a new roof. Right?
Yeah, I get that. My brother just yesterday was like, it sucks. He just came home from work and his air conditioner's out.
AC goes out.
It's not the coolant because so he's like, I have no air conditioner and I work outside. He works in construction, so he's hot in the outside and he comes home and he's like, it's the same temperature in my house.
So what do you have to do? You have to pay to put it in, right?
Yeah, I don't even know what he did. I think he went and slept at his mother-in-law's house.
Sure, you're not going to fix it that day, but the point is, though, if you're
he's going to have to fix it.
If you're the landlord, you got to fix it.
Oh yeah.
And if you're a homeowner and your AC goes out and you're like, okay, I'll go stay somewhere else, I'll figure it out. If you're the landlord and the tenant calls and say, hey, I got a problem, I got new AC, you got to get it fixed now.
Yeah.
You got to get it fixed now. When tenants move out, what happens? You have to turn them. You have to get in there. If you had tenants that were sloppy, putting holes in the wall, if the carpets or flooring is damaged, you got to go in there and make repairs. That's just constantly cost. Now let's look at mortgage notes. In theory, on mortgage notes, the maintenance or the property management is you're paying a servicer. If it's a performing loan, you're probably paying $20, $15, $10, somewhere in there, right? Well, when the AC goes out or the roof gets ripped off, you don't call the bank and say, here, I got to fix the roof. It's time to pony up. No, it's on the responsibility of the homeowner. So if you own the note, theoretically, you've got less.
Yeah, that makes sense.
Yeah, you've got less of
the maintenance.
You got less maintenance to do. So that's one of those things, which kind of leads right into what's the risk, right? There's a little bit more risk involved or a little less risk involved. So let's look at what's the risk if you own a rental. Well, they stop paying. Get
a
slip and fall.
I mean, yeah, slip and fall, but isn't there ways to protect yourself?
There's ways to protect yourself, but it doesn't matter. It's still there. Right? There's still, like, if somebody comes in and they do a slip and fall and now they got to charge you. Say that there's somebody at the house that's not living there.
That slips and falls?
They're having a party and somebody, the wood banister or the railing breaks and they fall off the front stoop.
Yeah.
Right? At the very minimum, you'll have homeowners insurance policies, stuff like that. But you could have, they can go to court and theoretically your insurance company's going to take care of it. But there's still always these risks, right? And if you have a lot of rentals bundled up under one LLC,
judgments on all your other.
Well, then you're looking at it going, how far do I want to take this? Do I want to push this? Do I want to try to go for more? And it's just there's pending, sort of legal things that could come up. Obviously, then with risk, there's unexpected repair cost. If a tenant stops paying, you've got to evict them, right?
Yeah, and isn't there like laws like
there's eviction laws, stuff like that. But the point is with that is just keep in mind how long an eviction can take.
Right.
Now let's go look at the risks on a mortgage. Well, obviously the risk on a mortgage is they default.
Right.
And you have to go, which your default's mitigated a little bit because it's protected by the note.
Oh,
right. So it's protected by the collateral, which is a house. And if you run into a situation where, you've had a note and maybe it's gone, I don't know, maybe it's halfway through the life cycle and the borrower defaults or the borrower dies, right? And now you're like, okay, well now I've got a dead borrower. I got to try to get the property back.
Right.
Right? So if you can go foreclose on it, take the property back, great, because now you're in a situation where you've got
the house free and clear.
You've got the house free and clear.
But couldn't that end up in probate?
It could definitely end up in probate. All those things can happen. But what's the time frame on a foreclosure?
It's a lot longer.
A lot longer, right? So this one, there's some there's risk on both sides. You face more risk with tenants damaging properties, and I guess if you're foreclosing on something, believe me, damage happens, and it might not be by the borrower. It might be they move out and it's vacant, and it's the neighborhood friends come in and decide to take all the copper, or to rip out all the wiring, or to take out the AC unit, or it could go on and on. So that one is, I don't think there's a point either way. Mitigating the risk on the rentals is nice because it takes less time to evict somebody. And oftentimes,
certain states, though, they have those long, crazy.
They do. There's longer evictions, but you can also write a check to get them out. Right? You can write a check to get them out. Mortgages, somebody's got some home ownership there. They know they can drag it out a lot longer. They get an attorney involved. Who knows how long it's going to take? They start fighting it. So let's go to tax benefits.
Okay.
The next ones are going to be tax benefits. It's a heavy point in favor of rentals, right? You can depreciate, you can deduct. There's all kinds of
write-offs
that can happen there. When it comes to mortgage notes, really, it's the interest income is taxed as ordinary income in most cases. So not a lot of real big tax benefits there.
Yeah.
You kind of lose that. Let's look at...
Hold on, so I'm keeping the tally. We're out.
Okay.
2 for mortgage notes, 1 for rentals. Is that right?
Well, it could be like you look at cash flow, and you get your cash flows going up.
Oh, that was 1 for each.
Well, yeah, but it's
so tied. 2-2.
I think it's kind of 2-2 right there.
It's
if
2-2.
I was going to have it, if I was going to say, hey, check, and you can do that and say, so, I mean, you kind of point where you want the victory. If it's initial capital investment, we'll put a check mark next to notes.
Oh, yeah, so the notes.
Then cash flow is going to go to the rental. Repairs and maintenance are going to go notes.
Yeah.
Risk, I'm going to that one's kind of a tie.
Yeah, so that's what,
Tax benefits is definitely, it's a clear cut for rental.
Okay.
Liquidity.
Okay, yeah.
Liquidity. Rentals, in theory, can be less liquid because you own property, you got to sell it. But the same thing goes with mortgage loans. You have to sell a mortgage note to get your liquidity back. The one thing with a rental is you can take out a HELOC, and you can really borrow against it a little bit easier than you could borrow against a mortgage note, right?
That's true.
And usually there's more money there to get. Notes can be traded quicker in theory.
Yeah.
You can have a note, you can trade a note in 3 days.
Yeah.
You find a buyer for it, you can tell it, you can be out of it. Doing a house takes a little bit longer.
Yeah. Because unless you know somebody, you got to get a realtor, you get that, all the whole listings. And
I would typically say I would give the edge on liquidity to notes in this one, unless you're doing some like a HELOC. Even so, though, the HELOC, it's going to take you time, so I guess it's a clear, their notes are...
Speed of liquidity, if you're saying speed of
velocity of liquidity
is going to be mortgage notes, because you can get that out ASAP. And then, but if you're, like a lot of people in rentals to do the BRRRR method,
Yeah.
You know that? Yeah.
Yeah.
So that's, but I mean, that HELOC, when I did it, a couple weeks, you know what I mean?
Yeah. So, appreciation potential.
Okay.
Well, this is a clear-cut winner.
Yeah.
Because it's actually the opposite of appreciation on a mortgage note.
Yeah, depreciation.
Every time it performs, it actually loses a little value. Rentals, you can look at cap rates as the market goes up and the value of your property appreciates. You're getting it. Wild appreciation over the past, really probably 6-7 years, 6 years, the appreciation has gone bananas, with the past 4 years just being really astronomical. Things level out. And on the mortgage note side, like I said, if it's a performing asset, they start with a balance of $250,000. They make their first payment. It's not worth $250,000 anymore. It's worth $249,960. So it's arguably losing value. Now the first 10 years it loses a lot less value than the last. Yeah. The mortgages are heavily weighted with interest up front most of the time. Control over the investment.
Definitely mortgage notes.
You think so?
Well, I mean, I think so. I think with the, I don't know.
Think about the underlying collateral. So you have more control with the rental because you directly control the actual property. right?
So yes, now, so I think there's like a caveat there. Like now, if you have a mortgage on your rental,
You still control the actual property.
right? But I mean, I feel like as the bank, you have more control because
You have less control as the bank.
you think so.
Yeah, you have less control as the bank. You can't control what the tenants or what the borrower does with that property.
Oh, okay. Okay, that's
So the control, because that's the underlying collateral, right? That's
Right.
what's securing your money. The house secures your money on both of these, whether you own it as a rental or you own it as a mortgage note and you're the bank. You have less control when it comes to mortgage notes.
okay.
You do. You know, you can, for instance, if you're a landlord, we kind of already talked about this, but at the end of the term, the end of the lease, you know, you're 60 days out and you got to give them written notice. And you're like, didn't really like this tenant. We're going to go ahead and we're going to change the rent from $2,000 to $2,500 to compensate for market. If you don't like your borrower, you're kind of stuck with your borrower, aren't you?
Yeah.
You're kind of stuck with the tenant for the length of your lease, and then you can get them out. That's not the case with the borrower. Your option is to get rid of the note. So I would say, for me, more control with the rental.
Okay.
So put that one in the rental column.
Okay.
Return on investment.
Matters what kind of notes you're buying.
Matters what kind of note you're buying, and it matters your rental property. Rental properties can offer really high rates of return, especially if you catch a run where you don't have a bunch of heavy repairs to do, and you're catching an appreciation cycle like we just had, an accelerated appreciation cycle. Like typical, you're expecting 3 to 4% a year, maybe 2 to 4% a year in natural appreciation with the market. Sometimes it outpaces that whenever real estate values are undervalued. So appreciation, you have a return on investment. You have the ability to have a higher return on investment. Mortgage notes are going to give you a more steady Eddie coupon clipping, they call it. Look, I'm clipping this as long as the thing keeps paying. I know what I'm getting. I can, if I buy a 19% return on my investment, I'm buying a 19% return on my investment. If you buy it right, you do the right underwriting, you got a good borrower, they keep paying, life doesn't happen, they don't get hit by a bus or have some sort of illness or something like that, you're probably pretty good, right? So it just depends on what you're looking for.
Yeah.
If you're later stage of life, you're probably looking for something a little bit more consistent. If you're younger, you can stomach more of the dips and valleys and just ride it the length. So you have more time, and you can wait for that appreciation to really go up.
Right.
You know, and mortgage notes typically have a 30-year life cycle. Actually, they don't have a 30-year life cycle. That's what they're papered at, but they don't typically go there. They typically pay off before that.
Yeah, you would hope so. Yeah.
And so then the last one is going to be, like, I guess, market dependency. It all really depends on the market, right? The availability of inventory. What's the real estate market like, right? The real estate, like going out to try to buy a rental over the past 3 or 4 years would have been pretty tough, right?
And you're also competing with people like BlackRock, which are trying to own the nation. You know what I mean? So,
Right.
And they pay above par.
So this one is interesting because there's obviously also, you have the mortgage notes are kind of dependent on what's the market look like. And mortgage note trading, it typically has an ebb and a flow depending on the market conditions in real estate. Right? When the real estate market is strong, houses are being purchased, not a lot of defaults, economy's doing well, what's going on? You're buying probably performing loans. Market drops, inventory starts to rise, economy goes down, there's more non-performing notes, you're buying non-performing. One of the interesting strategies, and this is what we did when we got into this, was it wasn't to get rentals, but it worked out. You buy a non-performing loan and you can go turn it into a rental if you want. So you can do that, sort of use a non-performing loan to bridge it to get a cheaper house.
Right.
Of course, you could just go buy it from a wholesaler or something like that and get a real estate property that way. But so market conditions, there's an ebb and a flow on both of them, depending on what you're trying to do. If I'm trying to, real estate market's hot, and I'm trying to build cash flow, looking at, that's what we're kind of talking about here is that cash flow. I'm probably leaning towards mortgage notes because the cost of real estate so high, and I'm going to have a large capital outlay to get involved. If the real estate market's not so hot, you might be able to get into, finding a decent rental. The old caveat there is if you can get financing. If you can get financing 3 years ago, 2.5 years ago, 2.5%, 3%, it probably doesn't really matter what the cost of the real estate is within reason, right? If the numbers work, you're like, hey, somebody's paying off my mortgage, I'm using that. So that one it's kind of, I hate to leave you with one where the last one's kind of like, it really depends. There's not a clear cut.
I mean, for me,
seems like you can always get into a mortgage note.
Well, I think there's just the timing of, I think the market's the most important. Really, and then also too, the other thing is, time commitments as well. So for example,
that's a great one, time commitment.
Yeah, for me, you looked at rentals and stuff like that. If something came up that made sense, then maybe. But there's also the thing is I'm not focused on building a rental portfolio to have a lot of management time. I buy mortgage notes because I set it and I forget it.
Right.
And it just shows up in my account. I just want the passivity of it. I like it because of that, and I'm focused on building Paperstac.
That's a huge benefit to mortgage notes. It can be very, very passive.
Yeah, I forget how many I have. So it's not many, but it's what? And then I'm just like, oh yeah, it's a couple pieces of land and a couple houses, and it's just like, oh yeah, it's good. And then I just go about my life. That's it. But the whole idea is, for me, the other thing too is, I'm trying to replace the nut that I need to make every month to pay for life. And so it's I feel with the mortgage notes, I have a more predictable path. Because I can say, I need this many mortgage notes that are paying this much money. Where are they? And then I can go and look at them and go, all right, well, I'm 40% to my my day of leaving the rat race, or whatever. Or that whole idea of, you have your cover. And God forbid something terrible happens, I at least know that I'm good here. And so that's how I like to do it, because I like to plan with the end in mind. I learned this from the last businesses I was in. These guys came from Silicon Valley, and they wanted to build another monster major company here in Orlando, and it imploded. But they would always say, look, let's look at the exit first. Let's work things backwards. And so that mindset is something I've always been like, okay, if I need to get here, how do I get here?
You gotta take a little bite. Hey, this is what I'm trying to accomplish. Little bites of...
Yeah, and then it's just time and consistency. That's really what... I feel like that's... A lot of people miss it. Everyone wants to get rich quick and, buy all these things. And now they're, it's if anything, I say, if you're going to start anything, give it a year. If you don't do it for a year, don't even start. But that's with any of the things like these, I have a time frame. I got to know my date. It's it's 2032. It's when everything will be, when I can I'm making the amount of the cash flow that's coming in to buy, and it just gets bigger and bigger and bigger.
Well, there you go.
Yeah. So, it's not a clear-cut winner. I think it.
No, I don't think there. But I don't know that would be a goal here. There's pros and cons to everyone, right?
Right.
And honestly, any financial advisor would tell you to do what? Diversify. Right? They're going to tell you, hey, if you can grab some rentals, let's say in 2031 or let's say in a couple years, your interest rates come to this ridiculous amount of 3% or 2% or whatever it is. And you're like, man, I could just go buy another house and I can keep this house as a rental.
Well, I've thought about that for my own house.
Right. Yeah, you keep that. I'm just going to go get a new house. I'm going to keep this one as a rental. And now I've got X amount of dollars coming out. And maybe your first year, you're not like, look, I'm not taking anything out of the rental for my first year. I'm just leaving that in the rainy day funds.
Yeah.
Or it's hate to have cash just sitting there not doing anything. Or maybe I'm putting this in, okay, I'm going to take the rent coming in and I'm buying more mortgage notes with it. Stuff like that. So diversify is the key there. The more you can diversify, the better off you are.
Yeah. So that was a fun episode, because
I don't know if it was fun. It was good. It was a lot of information. This could be a snooze fest to some. That's it for this one on the Paperstac Podcast, starting the new Versus series. It's not going to be back-to-back Versus series. We're going to filter these in. We did get some great feedback, and we will have more guests coming on here. There's somebody I want to get off of who does Airbnbs. He does a lot of social media influencer content, and I reached out and he's like, yeah, I'd love to do a podcast with you guys.
Cool. All right then, well that's it. So of course if you have your own questions, you can leave them in the comments, and if you haven't checked out the Academy, please do. It's academy.paperstac.com, and you can really learn deep diving into mortgage notes. But until the next episode, we'll see you around. See ya.